Hello and welcome back. I'm Dr. J from OptionMonster.com. This is Time is Money, sponsored by our sister company, TradeMonster.com, where you can trade options for just 50 cents flat, and where they have paper trading now too, folks, where you can open an account, you don't even have to fund it, and you can actually trade all the strategies that I talk about right here on this show, see how they would work out for you without committing any capital to the trade, without even having any money in the account. That's only over at TradeMonster.com, so check it out. Now, as far as what I'm looking for next week, it's been a pretty volatile time here, but so far, this is Wednesday of the first week in March. We did see 689 hold in the S&P, and a little bit of a rally, a little bit of optimism creeping back in, but only a little bit. On the other hand, volatilities have been coming down rather substantially. As I have said repeatedly on television, the market and the outlook for traders back in October, November was significantly more dour back then than it is today, because the volatilities were double. They were 89 on the highs, which is when the market was hitting those lows back in October, and now the VIX, that same metric, is trading at half that level or less today, and that's a good sign. But Joe and Jane out there on the street, they're feeling it right now pretty bad, folks, and that's why I say today's rally, a little bit on Wednesday, the 4th of March. Now, as far as what's going to be happening next week, as we like to do on Time is Money, Monday and Tuesday we've got the big CBOE Risk Conference out in California, and Nouriel Roubini is going to be keynoting that conference. Nouriel on the academic side, Meredith Whitney on the actual practitioner side would be two of the biggest names. It's only Nouriel out there, not Meredith, but hopefully you'll be hearing more about us doing things with Meredith, because I respect the heck out of the lady, and she's been dead on with her calls. But that risk conference, Monday and Tuesday next week, out on the West Coast. Also next week, we've got earnings out of Kroger, Kroger, biggest grocer in the United States, and shares are down from about $28 level to $20. They've just started to pick back up. And obviously some of the things you can cut back on, those things don't really or aren't really part of what the grocery store experience is all about, unless we're talking about Whole Foods or Whole Paycheck. So when you take a look at Kroger, when it gets down to these levels, I think people have cut back about as much as they can cut back, and I think KR is probably a reasonable do here, meaning I would be a buyer of Kroger. We have not had unusual activities here, folks, but I think a cheap shot for a stock that has come down $7 in the last quarter from 27.5 down to 20 would be buying the Kroger March 20 at the money call and selling the 22 calls in Kroger KR. So that's what I'm setting myself up for. Earnings are Tuesday next week, so you have some time before you have to put that trade on. Another one, take a look at Staples, SPLS. Staples down from about $18.75 down to $15. It does appear that over the last couple sessions, Staples has tried to find a bottom or a bounce area at 15 or thereabouts. Again, that symbol SPLS. They've got earnings on Wednesday next week. Because of some of the fear that's built up in here, we may be able to sell some put spreads to take advantage of that, because of course if the stock flattens and just trades in a range or goes up, those two are favorable for people that have sold put spreads, and that could be a nice way to play this one. So Staples, again, where the Lakers play, the Staples Center, I believe, that has earnings on Wednesday next week. If you come back from the break, I've answered some questions that people have posed to us on Twitter. You can also follow us, Option Monster, at Twitter. We are regularly posting information there. And right after this break, I'll tell you what one of the questions was and my answer to it right after this. All right, folks, welcome back. I'm Dr. J again from Option Monster, and our sister company, Trade Monster, does sponsor these Time is Money events. Hey, Andrew, how about those cookies? We're going to rip them off from all these guys. What do a bunch of hungry monsters eat? There's Andrew. Girl Scout cookies, of course, folks, and the Girl Scouts have not paid us for this endorsement, but this is what you feed a bunch of hungry monsters. Thanks, Andrew. Because time is money, let's get back down to what's trading in the markets right now, shall we? Take a look. The question posed to us by, and I'm going to read this off because it's not really directly a name, RRJASKIE. That's RRJASKIE. That's his handle or her handle on Twitter. And they said, hey, Doc, what about Apple? AAPL. What's going on there right now? And what we set up was just what Andrew's going to put on the screen here, a call vertical, or rather a put vertical. What I'm doing here is I'm selling a put spread, just what I talked about, for instance, in Staples. If you take a look at how this one would go, I'm looking at doing the 90-85 put vertical. Stock stays higher than 90. Both sides expire worthless. I keep whatever credit I took in for the spread. Now, it's exactly the same, by the way, folks, as doing a bull call spread with the same strikes. In this case, though, we are collecting a credit, and that credit was right around $2 for that $5 put spread. We keep that credit in our hands if the stock is 90 or higher, and if it goes to the downside, that spread could only go to $5, which means we could lose 3 if the stock traded all the way down to 85 or below, but that's the full limit of how much we could lose. So I guarantee you, if this call spread, or rather if this put spread is trading at 2, the call spread, folks, is trading at 3, because together they're going to create a box. And since we're talking $5 differential between the 85 strike and the 90 strike, that will always be $5, folks. So we're selling that put spread for $2, the 90-85 put spread in April. And then if the stock's 90 or higher that third Friday in April, well, cha-ching, we keep all that cash. And if the stock is 88 or lower, we're going to be put stock, but we do have that put that's just out of the money, the 85 put, to protect us, to make sure the worst case scenario we could lose 3 on that trade. I'm Dr. J from OptionMonster.com. Remember, we're going to be in New York City for a big tweet up outside Fast Money. Andrew's going to be out there with everybody, and a couple of you might even be coming inside the studio for Fast Money. That's this Friday, March 6th. And then March 7th, we've got the Invest Like a Monster seminar in New York City. I'm sure there are still some seats available, so check it out, investlikeamonster.com. I'm Dr. J from OptionMonster.com.